and Coverdell education savings accounts. Okay, starting with the traditional IRA, how it works, earnings can be tax deferred until withdrawn. Contributions can be tax deductible if you qualify. Must have earned compensation, cannot reach age 70 and a half during current year, and contribution limits are $5,000 for under age 50 and $6,000 for age 50 or older. For employer-sponsored retirement plans, participation will not affect your ability to contribute to a traditional IRA. Eligible rollover distributions can be moved into a traditional IRA to continue deferring taxes. You can inform your plan administrator that you want to move the funds via direct rollover if you want to have it. Okay, for a Roth IRA, you can contribute to both types of IRAs. Annual contribution limits apply to any combination of traditional and Roth contributions. To move the money from a traditional to Roth, you would use adjusted gross income. It's $100,000 or less, single or married, and filing a joint tax return. Pay federal income taxes on the amount moved. And for taxes, you may owe income taxes when you withdraw from your traditional IRA. Portions of a withdrawal can be treated as the non-taxable return if qualified. Non-deductible contributions were made to the IRA. And for penalties, you must pay a 10% tax on withdrawals unless you qualify for an exception. These are the exceptions that we have listed here. Amount is rolled over or directly transferred. Amount is properly converted to a Roth IRA. Withdrawal of excess contribution. Payment is made to your beneficiaries. Up to $10,000 for first-time home purchase. Post-secondary education expenses. Used to pay for medical expenses or insurance. Qualifying pre-59 and a half periodic payments. Disabled or federal tax levy. Okay, and then there's also a required minimum distribution that you must take. It begins receiving at the age of 70 and a half. The minimum distributions each year will be computed using an IRS formula. The RMD election would be when you want the money, how much, and any withholdings that you want to take. And beneficiaries. One or more beneficiaries may be designated to receive your IRA after your death. Spouses may directly transfer your traditional IRA into your own IRA tax-free. All beneficiaries' options include a lump sum payment or periodic payments over a number of years. And I'm going to let Becca lead the Roth IRA end of it.
Okay, so how a Roth IRA works, withdrawals may be tax-free, contributions are non-tax deductible, must have earned compensation, and must meet modified adjusted gross income limits or MAGI limits. The contribution limits are the same as the traditional, with $5,000 over the age of 50, or under the age of 50, excuse me, and $6,000 if you're over 50. With employee-sponsored retirement plans, your participation in those will not affect your ability to contribute to a Roth IRA, and you can contribute past the age of 70 and a half if you have earned compensation. Tax-free withdrawals. There are two requirements to have a tax-free withdrawal. You must meet the 5-year test where you have the Roth IRA open for at least 5 years. And then you must have one of the following exceptions as well. Over the age of 59 and a half, funds are going to a beneficiary upon your death, disabled, or again for a first-time home purchase. Required minimum distributions. These are not required with Roth IRAs. You can leave the money in there and let it grow tax-free as long as you want.
So that's the difference between a traditional and a Roth?
Correct, yeah. With the traditional, you have to take those when you reach that age. Beneficiaries, upon your death, the IRA money will be passed on tax-free. The 5-year test must be met for this as well. If it hasn't been met, then it'll have to sit in there until it is distributed out to the beneficiaries.